Hello everyone, welcome to another Asset Control interview special entitled Insufficient Model Risk Management, where we'll be discussing if models and data assignments are reliable enough to ensure they can be trusted to navigate you through these risky waters. If you happen to miss any of the other data sins within this series, Asset Control will be releasing all 7 sins in an ebook to be published at the end of September. Changing the format a bit, this week we'll host an open discussion between John Matwey from Red Swan Risk and Stef Nielen from Asset Control. John Matwey is the founder and CEO of Red Swan Risk, one of our most recent partners. As the managing partner of Red Swan Risk, John specializes in model risk management for hedge funds, asset managers, and banks. And Stef Nielen, who has actually recently joined our international team as Director of Strategic Business Development for the buy side. Stef brings 20 years of experience and deep domain expertise on the distinct processes hedge funds, asset managers, investment managers, and asset owners perform in the areas of market risk, credit risk, hedge fund risk, private equity risk, enterprise risk, and performance management. Having worked for industry leaders including MSCI, RiskMetrics, and Axioma, he is well known in the industry as a trusted advisor to some of the largest asset managers and asset owners. A fun fact is that both John and Stef have worked together at RiskMetrics in the past. On that note, I'll let them take it from here. Enjoy.
Well, thank you, Alex. Thanks for that. Today we talk about the 7th sin, and we really wanted to talk about why, there's a possibility to have insufficient model risk management. But the main question is to you, John, is are models and data assignments really reliable enough so they can be trusted to navigate through risky waters? Let me start with what my assumption is. That's that investment managers, use the models and simulation techniques to represent the dynamics of the capital markets, but model behavior itself is very much dependent on what you put in, right? And it's dependent on the model itself, but it's also on the data that goes in. And maybe you could elaborate a little bit on that, how important that is in a case of risk management.
Yeah, I think let's first say this, that it's pretty normal to see things behaving strangely from time to time. That's kind of par for the course for any risk manager. Someone looks at a report and says, what's this strange number? So getting to the bottom of that is really at the heart of the matter, and doing it efficiently, particularly when the markets are misbehaving. If you can explain how you modeled something quickly and understand all the various configuration choices you made, then you can determine whether or not this is a real signal or a false signal, and perhaps even identify an error that you made. The real problem is when you're blind to it. And that's sort of the unforgivable sin, is that you're seeing something and you have really don't know where to look. There's nothing transparent to you.
So can you elaborate a little bit on that? What do you mean you're blind to it? You know how the models work, right? And you know what kind of market data you give as input, but still you're saying you could be blind to and unaware of certain things?
Well, right. So let's just say first this. The model is a representation of what's happening in the capital markets. We come up with a model. There's some analytic behind it. There's some market data. There's some configuration that says take my security and link it to that in some manner. And there are lots of variables that go into it. Oftentimes, this may be someone may have followed a set of instructions to perform the stitching together or mapping exercise, but it may be buried in some code. What you just see is an end result. I own something over here in some model, but I don't know what that mapping looked like. That's really where the challenge comes in. There's many variables. It could be the market data. It could be the quantity. It could be something as simple as the put-call direction. And someone literally have made a mistake in code that you just can't see that. And then you're reconciling, systems and trying to understand what occurred.
So you might be able to introduce some distortions that you're not really aware of. I think it was your colleague Jim who coined the term that he said an imperfect model might still have value as long as I'm aware of what's wrong,
Right.
and what these imperfections are. But
Yeah.
you're saying it's not always clear that there are these imperfections, or how do you deal with this?
Right. So it's perfectly reasonable to make a decision that to model security that is not going to perfectly represent what's happening in the marketplace. It could be a proxy. You may be proxying it to an index that's completely adequate because for example, they both it has a beta of 1, and it's a large cap stock, and it behaves like the S&P as a generic example. You know that perhaps it has a slightly higher beta and you've adjusted for it, but you're aware of the decisions you've made and what the imperfection is. Perhaps it's a credit model where you haven't used the actual underlying information of that specific company, but you've used something in that industry that's sufficient for what you're doing and you're aware of it. So in those cases, I think it's just the awareness of the accuracy of the model. Label it as such. You can see that, as opposed to having put it in something and not knowing which index you put it in. For example, you put things that are fixed income instruments. You've proxied them with an equity index. Well, that's probably not something you want to be doing. You're not going to get any interest rate risk. Even though perhaps at some point the correlations made sense, if you follow me.
Yes, I do. But I think a lot of clients would ask, okay, but if I buy a risk system, and it's got coverage for all these models and things, doesn't that come out of the box, and don't I have, that thing covered, or do I still need to worry about this model risk you're talking about?
Right. Yeah, that's a very good question. You would think at this point in time that we should know everything that will go into the risk system, and it should be built that way. The systems have gotten much, much better over time, and for many instances, they can do that. Problem is there's new instrument types being invented all the time, and new securities being issued. There's over-the-counter instruments. By definition, you're not going to understand what it is until you see what that term sheet is. So, and typically, the challenge here is that for your bread and butter stuff, say, for example, 75 or 85% of your portfolio, perhaps it's as simple as an exchange-traded security that goes into the system, and the vendor does an excellent job of that. They have all the terms and conditions and so forth. But you're hedging it with a derivative of some sort. And that essentially is driving the entire risk of the portfolio. So dropping out a small percentage of the portfolio in mapping and modeling has a huge effect on the view and the optics. And that's really what the challenge is. It's getting that last mile or in getting it right.
Is it also about when you have, let's say, bonds, but you have to find the right curves for these bonds to discount all the cash flows, but you might bring some inconsistencies there. Is that what you and your team have run up against and found a larger solution to overcome?
Right. So let's think. There's two aspects of that. One is, well, where would be an example where that would be challenging? And then, why do you need to systematically solve for this? Let's think about it from this way for a standpoint. The choices that are available in these systems, I'll give you a generic bond example. I think it's something on the order of 100 to 150 different fields that are available to model securities with that particular model and one particular system. Well, that's a wide range of choices you could be making. So if you have the data available, you may want to be very specific about how you model those things based on perhaps you bought market data partners and you have single name CDS data or the bond prices for the securities that they have. In this case, you want to be very specific and you have idiosyncratic risk going on there. In other cases, you might want to create some sort of a waterfall structure where you are essentially categorizing things based on maybe ratings and sectors. but it's your view of that as opposed to someone else's view of it. You've applied your own ratings to those. You've applied, your sectors are internally, you look at those differently. So you want to make sure that you apply that so your groupings and risk bucketing is something that makes sense to the way you actually trade your portfolio.
So on the one hand, you're talking from a model perspective, and I have to find the right curves to model my particular instrument.
Yeah.
And I want to do that consistently. On the other hand, you're even talking about enrichment fields, tags, or user attributes that might not have come through in a consistent way, and still this will influence my slicing and dicing and bucketing of my risk groups.
Absolutely. So let's take a couple of those examples. So you could have a benchmark, for example, and there are ways of categorizing the securities in the benchmark within, say, sectors, for example. But you have your own view how you do it internally. Both of those must be aligned. Those tags have to be in the same buckets, or else you're just basically going to introduce a bunch of tracking error. This is independent on whether or not you have modeled them consistently. It's that they're literally sitting in the wrong risk bucket. Separate from that, you could actually have had benchmark data mapped as a service, for example, under one set of rules,
right? But
you've mapped yours under a different set of rules. And you could create a different mismatch from that, which could be even more severe than the other type. So there's many reasons to be cautious about this. And this is really what gives risk managers and analysts such giant headaches when they look at these reports to trace these things down if they don't have tools that have a great deal of flexibility and configuration capability. It's a massive task to go ahead and address these issues.
Wow. And so typically you would see clients wanting to, they model their portfolio really, really well, and they put all the attributes there, but then they just bring in the benchmark from the provider, and they can't do a relative analysis in a proper way because, things are mismatched.
Yeah, and it's great that you can get this stuff brought in. It's a lot of work, and it's terrific that you can get a managed service to load that for you. It's just that to get the ultimate utility out of it, to minimize the distortions, there's more work that needs to be done, right? You're going to have to override those tags with the same consistency across both your portfolios and the benchmarks. And what you really need to have is a mechanism by which you can work on this. This is where the concept of a unified data model, for example, is so critically important. It's not just whether or not I've got each individual security with the right set of tags and metadata that follow it through. I need to know how it was modeled. What was the mapping rule? I need to see how that was applied to the benchmark. And I need to have a framework so that I can essentially apply these tags uniformly and override them for both the benchmark and the portfolio that you're trading. And it's that concept of a model that looks across all of this that's so essential. We see that this is often completely missing. The assumption here is that it's done right once, benchmark, and ours is going to adhere to it because it came through the same system. Nothing can be further than the truth.
Right. I can imagine these problems giving a headache. Like, for instance, if you're switching a benchmark, some providers might have GICS as their sectors, others might have ICB, and I can imagine that there are also sort of different, I would say, ratings and things between what your benchmark provider might bring in as well as your own portfolio.
Those are classic examples, and the others would be blended benchmarks. Some people say, we're using these two benchmarks with a specific weighting, which just introduces a whole other level of complexity. And this gets to sort of the ability to take your portfolio and create your own blends of it and appropriately blend benchmarks as well. And this sort of gets to the need for being able to work with the data in a way that you don't, again, introduce a distortion.
Right. And I can imagine for large asset owners, when they just want to roll this up as a total plan, it becomes quite a daunting task. And so when you say, you talked about consistency and you want to have that consistency and the unified model that you have helps with that. Last time we spoke, you also mentioned something when it came to mapping of the data, the constant maturity curves for commodities.
Right.
Why? Can you elaborate a little bit on that?
Yeah, sure.
Why was that a nice example to explain the use case for a unified model?
Yeah, this is, now I'm dating myself a little bit because I'm going back to some problems that I had when I was acting as the chief risk officer. But some of the benefits of these things like a constant maturity curve is that I don't have to keep going in and changing the curves. They essentially stay at the same maturity for me, which on the one level, it makes it easy for me to go ahead and put things into a risk system. The problem is,
but it comes at a price.
It does. And what it really means is it is a proxy, right, for what's actually behaving, and it's derived data based on the actual futures contracts that exist in the real world. That's what people are trading on. So if you have people doing, commodity future arbitrage between doing calendar spreads or volatility trades or what have you, it's very important to be looking at the empirical underlying data for each one of those instruments. Otherwise, you start to introduce, you can essentially underestimate the risk, for example, for a calendar spread, because you're sharing part of the same data when the truth is you're actually on different instruments. And let's take the example of, didn't we see negative $40 oil at one point in March? Or was that April?
Not too long ago, yes.
Yes. So these types of things are never supposed to happen. They did. And the risk system in a scenario of a constant maturity curve, for example, wouldn't be able to handle that type of thing. I'm not even sure if all of them can handle the negative rate, but sometimes these markets are very disrupted. And this is another example of where the proxy methodology based on the empirical data being then turned into a derivative of that is not suitable for all conditions.
Right. So yes, you mentioned that earlier. You start to see all these things sort of float to the surface under crisis conditions, right? It's not like you're always, see these things straight away and but they really start to appear, and you're just looking at model risk, not like real risk, but model differences in base risk and model risk. But you mentioned that this will really appear under crisis conditions.
Yes, and unfortunately for anyone who's been in the fire, you often find that there was a mistake made at some point, a month ago, a week ago, God forbid, maybe it was even, a year ago. But the error occurred in a small size. So at the security level, you could say it was imprecise, and true enough, there was model risk that existed. But unless you really worked hard on validating that one security under a wide range of conditions, you may not have picked it up. It's sort of innocuous. Then what happens is two things. One, that may have been put in larger size suddenly, and at the same time, you're getting a large increase in volatility. So the riskiness of it has jumped up at the very time that it's giving you a distortion, which is the worst possible time to be discovering this problem. And so this is where the transparency into what occurred is so critical. You need to be able to look immediately and see the complete data lineage. Where does this come from? What was the mapping rule? And analyze what is causing the problem. If you can determine that it's real, then you've got an issue that must be addressed by trading. Someone must take an action on that end. But oftentimes, if you can trace the data lineage, you can tell whether or not you made a mistake in the mapping rule or potentially the input file that went into it suddenly changed there. Someone changed the field in the database, and that call has suddenly become a put. And that's a big problem at exactly at a critical moment. But at least you know where that occurred and you could quickly trace that and correct it, as opposed to flying blind and not being sure what happened at all.
Right. So this is where you see our products really come together nicely. On the one hand, you've got your unified model within Red Swan, and we at Asset Control can bring that data lineage in and can bring that consistency in mapping quite strong for all your securities across the board.
Yeah, and I think, for the what we hear often is people will say, well, for this specific thing, I know how to solve that problem. I go get the data here, I create this rule, and I'm set. I know what that field looks like in Bloomberg, and I can convert it to this other field in this risk system. It's not a problem. The issue is that when you're looking at the nature of the problem today, you might be able to solve for that set of conditions. What you don't know is the nature of the conditions tomorrow, a week from now, or a year from now, nor do we even know if that same person's going to be working on the problem. So what you really need to have is a system that solves for a full range of these. Now, with asset control, you're looking at 30 some odd different market data feeds that you are solving for. So you're looking at the full scope of it. The client's not going to outgrow that system just because they've gone ahead and traded new instruments or they need to model a new security. And we take the same approach at Red Swan. We look at all the available model schemas, every possible venue, a way of going ahead and configuring a model, and we make that readily available in something that's very user-friendly. That way, the client, if they're only doing 12 instruments, and then tomorrow they're doing 25, there's no changes they need to make from the standpoint of getting a new system. It is going to grow with them very nicely.
So it lowers your switching cost and switching risk, essentially.
And I think it addresses the dynamic nature of the portfolio changes, the types of the instrument coverage changes, over-the-counter instruments. New things are made available. There are instruments that trade today that didn't exist a year ago. And so I think its ability to essentially address the dynamic nature of what people like to do when they trade.
So to model things properly, be it a simple proxy or sometimes a more granular thing and exact, you still need that setup that dynamically can configure things because it's always evolving. That's
absolutely
right. And through time, and it gets better and better. But where people work, mistakes are being made, and you should be able to have that data lineage capability to trace it back and see where it's gone wrong. And
absolutely.
Not only that, but you probably also need that from a regulator perspective.
Right. So, sort of the definition of model risk management really has to do about if you can point to the entire lineage, where did the data come from? How did you treat it? What have you done to modify it? What market data have you assigned to it? Where did the tags arrive from? What models did you use? And then what did you do to it before it got into a report? It used to be that you could just show a report and a number. They actually want to be able to trace where did that number come from, and can you explain that to me? The regulators have made that clear that that's important, both in Europe and in the United States. But in a practical matter, if you can solve for that, then you've got a pretty good system. And it makes it a lot easier and believable that you're actually, applying risk management. And it allows you to get the maximum value, I think, out of the investment into these risk systems, which, let's face it, they're expensive. They're very sophisticated. So God forbid you put it together in a way that you don't understand how it works. You need to put some additional investment in to really extract the maximum value out of it. And that's what we're trying to do here.
Right. Well, thank you, John. I think that really sums up well why it could be a data sin if you have insufficient model risk management in place. But with both our tools, there should be no excuse to avoid that. So thanks again. I really appreciate it. I think we can talk for hours. So we should probably set up a next video.
Indeed.
Video log soon, but for this data sin, I think we captured the essence. So thanks again, and I hope to talk to you again soon.
Okay. Thank you, Stef.